Good morning, everyone, and happy tax day. I'm Brad Smith alongside Rochelle Akufo. This is Yahoo Finance Live. Let's hit the top 3 things that you need to know to start off your morning. First thing you need to know, another big day for bank earnings. First up, Bank of America. The company's rise in profit was boosted largely by higher interest payments. The bank's net interest income jumping by 25%, matching reported performances seen at JP Morgan and Citi. Deposits at the bank were down after March's banking crisis spooked customers looking to move their cash. Goldman Sachs was harder hit this quarter, posting an 18% fall in profit. Now, Goldman's revenue is heavily reliant on Wall Street activities, unlike its more diversified rivals who enjoyed boosted income from fixed income trading. Chairman and CEO David Solomon called the first quarter a real-life stress test. All in all, large banks appear to have held up well during March's upheaval, easing worries about the banking system's health. Second thing that you need to know, China's economy is gaining at a faster than expected pace. The country reported its first quarter GDP rose by 4.5% year over year, marking the strongest 3-month growth span since last year. China's economy seeing benefits since lifting strict COVID restrictions and easing crackdowns on large tech firms. Retail sales, they climbed by 10.6% in March, significantly beating expectations. Industrial output and investment, they were also up, although both came in shy of forecasts. The one troublesome outlier in China's economic report is the near record high unemployment rate among 16 to 24-year-olds. One Macquarie economist speculating that boosting youth employment may be a challenge with several businesses in wait-and-see mode. And the third thing that you need to know, the playoff season for the IRS. It begins today. Midnight tonight is the official cutoff to file your federal tax returns, but taxes must be paid today, extension or not. If you're cutting it close, we'll have some last-minute tax tips later on in our show that you do not want to miss. Plus, the IRS has cut down call waiting times and cleared a massive backlog of returns thanks to additional staff. We'll look at what the agency's $80 billion boost in funding means for the taxpayer experience moving forward.
As you mentioned, they're happy tax day. Not happy for everyone, but shifting gears to focus on these bank earnings that are really piling in this morning. We have Goldman Sachs out with its results. The bank beat on earnings but missed on revenue as it takes a hit from the sale of consumer loans and weaker than expected bond trading results. Investors were closely watching to see if the March banking crisis hit Goldman in particular, as the bank gets most of its revenue from trading and investment banking. So an interesting picture here, because we did see fixed income trading revenue in the quarter fall 17% to $3.93 billion, really not capitalizing on this rush we saw into fixed income that a lot of these other big banks enjoyed. And also taking a look at what happened with Marcus. Goldman said it posted a $470 million loss on the partial sale of its $4 billion Marcus loans portfolio, and then moved the remainder of the loans to held for sale. But that really did also contribute to the revenue miss as well. Retail banking, which has been a common story, but plays a much smaller role in Goldman. But like Bank of America, those deposits also down. Those were down about 3.1% quarter over quarter and year over year. So lots to watch here. And as you mentioned, mentioned at the top of the show, CEO David Solomon saying the events of the first quarter acted as another real life stress test, demonstrating the resilience of Goldman Sachs and the nation's largest financial institutions. But as we're seeing, it's really playing out differently depending on how diversified you are. As we mentioned, with Goldman Sachs really focused on some of these Wall Street activities, not benefiting as much as these big banks, Brad.
Yeah, this is a huge time for Goldman Sachs in kind of two different measures. And one of those measures, of course, what we were seeing within the broader banking turmoil, trying to reinstill confidence, of course, in the broader system, even though they had to acknowledge, and this was the first line of this report, as I was mentioning earlier, the first line of this report coming from CEO and Chairman David Solomon saying the events of the first quarter acted as another real-life stress test, demonstrating the resilience of Goldman Sachs and the nation's largest financial institution. So really gives a nod to the different type of position or the benefit that a large bank has given its stature, given its scale versus some of the regional banks, given the run on deposits that we had seen and that real life stress test, as they called it. But then on the consumer side, you also think about where technological innovation is continuing to move forward, especially among some of the largest banks and the financial services sector. trying to become more relevant in, day out purchases. And we saw that just yesterday as well, within the recent announcements from Goldman Sachs and Apple furthering their relationships to try and make sure that on Apple's front, they get a little bit closer to the everyday transactions that we make. I mean, I know the second that I tap, I'm like, I'm not paying, Apple is paying. That's what goes through my mind. I forget that it's coming out of my account sometimes because it's so simple. But I think now for many consumers trying to figure out, okay, what does this mean for some technological firms who are now merging their own ambitions with the larger bank or wealth management institutions? I think these types of relationships could only become further known at this point in time and really elevated. And that's just what we saw between a big name in banking and Goldman Sachs and wealth management in Goldman Sachs. And of course, the tech behemoth that Apple is. And so that certainly one of the more trending stories on the day recently. Also, another bank that we heard from this morning was Bank of America. The company beat on profit and revenue, and its trading revenue that countered some slowing loans here. And there were really three things that I took away from this. I'll try and hustle to my finish here, Rochelle, but I got kind of excited about this, so much so that I dialed into the earnings call, and I'll have a little bit more on that later on. But three things real quick. First and foremost, the elevated credit and debit card spending. This is something that we've heard about from the household debt and credit developments from the New York Fed. They continue to give us some updates there. This was up 6%. One read on this could be into how much consumers need to rely on credit spending in the face of or instead of relying on some of their cash spending. And particularly going to be interesting to see in further reports from the New York Fed as well, where delinquency rates have increased because they've already increased for nearly all debt types. And that was as of the end of Q4 2022. So once we get that Q3 update, that's set to come perhaps in the coming weeks. That's going to be interesting to see. So I kind of correlated it with that from the New York Fed. Also was taking a look at another key takeaway here, the return on tech investments. We were just talking about this relationship between tech and the investments that big banks have made. Well, for Bank of America, digital usage, that continued to grow for them. They had a record 73% of all overall households actively using their digital platforms, record 45 million active digital banking users. That was up by about 6%. And then 1.8 million thereabouts digital sales. That was up by about 4%. And so all of that considered, you also think about the relationship with Zelle here. Zelle, of course, a common household term now. 19.6 million active Zelle users sending and receiving 275 million transfers worth about $84 billion here. So it'll be interesting to see how much of that gets reported. Of course, I mean, as we're reporting taxes, some of those digital payments are going to be new for the reporting of your taxes this year. And so we'll be watching that. And then just lastly here, I'll shout out the total deposits here. And this was going to be interesting with relation to, of course, the banking turmoil that we've seen. We've got this chart to see how that moved lower. It was kind of minimus. It was a single-digit percentage move lower, but still worth noting here for Bank of America, Rochelle.
Indeed, and we mentioned this fixed income rush that we did see that Goldman Sachs wasn't able to capitalize on. A very different story for Bank of America. Fixed income revenue rising at 30%. And once you do have that big name and you have more sort of retail consumers, obviously now Bank of America was better positioned to take advantage of that than Goldman Sachs. But an interesting tale, a tale of two banks as we continue to look at it, Brad. Absolutely.
Well, let's dive more into these bank earnings and what it all means for investors. Joining us now, we've got Interactive Brokers Chief Strategist Steve Sosnick, along with Odeon Capital Group Financial Strategist Dick Bove. Great to have you both here with us today. Steve, I want to start things off with you. Give us your 10,000-foot read on what we've seen from the banks thus far and kind of what it sets up for the health of the economy and really where the consumer finds themselves right now.
Good morning, Brad. I think right now the investors are being a bit discerning. I think we were coming into this with a bit of a fear factor of which banks might disappoint. We still haven't really heard from the ones that I think are more vulnerable, and I'll let my esteemed other guest get into that in a bit. But we basically, we're distinguishing which banks are the leaders, which are the losers. I've never loved the idea that banks lead off earnings season because we start talking about things like fixed income trading revenues and stuff of that nature, which have no impact on any other business anywhere in the country, or even to a large extent other banks. But this time it was very important just to hear what, let's get things kicked off I think we learned that J.P. Morgan is really, the biggest among big. I called Jamie Dimon, Bruce Springsteen, and the rest of the other bankers the E Street Band. But that's kind of the role they showed that they have. And we're learning case by case. MTB they loved, State Street they didn't. So I think we're getting pretty discerning. And I do think we want to see, but I do think people are happy to see that for the most part, there's not pervasive trouble, at least that we've seen so far.
And Dick, I want to get your take as well, because given the expectations going in, a lot of the panic that was surrounding the banking scare, in terms of your reaction then to what we're seeing with these bank earnings and perhaps what we should be keeping an eye on, as we keep in mind it might not tick in until the next set of earnings. What are you keeping an eye on here?
Well, I think what they're doing in banking is most important. In other words, generally speaking, people would look at year-over-year numbers when assessing, bank results, because this is it's a cyclical industry and it's a seasonal industry. But this time around, I think it's important to take a look at the quarter-over-quarter results, because the world is different. I mean, we are not in a low interest rate environment. We are not in a situation where the Fed is expanding its balance sheet. It's shrinking its balance sheet. So I think the quarter-over-quarter numbers in banking are most important. And when you go through each one of the banks, whether it's J.P. Morgan, Wells Fargo, Bank of America today, what we're seeing is, little to no growth in loans. Most of them show declines in loans. Virtually no growth in deposits. Virtually all of them showed declines in deposits. We're seeing an increase in loan losses, and the increase is highly associated with consumer activity. And we're seeing, that their margins are under stress. And if we were to narrow it down to just the last month, the month of March, it would appear that there's negative numbers in all of those respects. And I think that's what, you have to look for in terms of going forward. And what Steve said was incredibly important. He said that nowhere else in the world do they care about what the trading results are, for banking companies. And that's absolutely correct, because basically all of the increase in profits that we've seen on a quarter-over-quarter basis have come from trading. And the fact that people are sitting all over Goldman Sachs today doesn't seem to be quite correct, because, Goldman's fixed income trading quarter over quarter was up 66%, and their net income in the quarter, again, quarter over quarter, was up 161%. So when David Solomon says this is a litmus test, he was thinking that we did a pretty good job in the quarter. Everybody else is saying, well, wait a minute, we want to look year over year, and we don't think you did so great year over year. But Goldman actually had very strong results in the quarter, and Bank of America, like its peers, showed weakness in all of its banking activities, and I think that's what people have to start thinking about.
Hey, Dick, just while we're with you, 1 second, I want to also ask about the loan provisions that each of these banks have set aside in one capacity or another. Is there anything that you look at within the loan provisions that have largely increased across the board for the banks right now that is still tied back to the banking turmoil that took place in March and them trying to really get a wrap around what is still perhaps yet to come on an economic standpoint, where we had Bank of America and Brian Moynihan doubling down, or at least reiterating their forecasts for a Q3 2023 recession to begin at that point?
Yeah, well, you do have to disaggregate the loan loss number. It's composed of two elements. Element number one is, what did the banks actually lose on their loans? And element number two is, what do we estimate they will lose in the future? And if you take a look at every one of these banks, every one of them, they showed a significant increase in the actual loan losses. And in the case of some of them, like Bank of America, they made the assumption, which was, in my view, totally hypocritical. You can't say, that we estimate fewer loan losses in the future and then say, that we think there's going to be a recession. But what you have to focus on, forget the loan loss provision, look at the actual charge-offs. The actual charge-offs were negative. And they're negative because there's been too many credit card loans made. They're negative because the inflation rate is too high. They're negative because auto loans, prices are dropping below where these people actually bought the cars for, and they hooked them into 7 and 10-year loan agreements on these cars, which are declining in price. So the consumer is going to create a great deal of difficulty for traditional banking going forward. But as I said, bottom line, a bank has to take in more money. They're not doing it. The deposits are going down. They've got to make more loans with that money. They're not doing that either. What they're doing is they're making a heck of a lot of money trading. And that's not the core business of the banking industry. The core business is not doing well. And that's what you're going to look at over the next 3 quarters this year. You're not going to be looking at trading. You're going to be saying, what went wrong with net charge-offs? What went wrong with why we can't hold on to deposits? What went wrong with why we're not increasing our loans? And therefore, my view, since this rally started, was people are relieved that the banking industry is not in disastrous shape, but what they're really focusing on is what they really should be focusing on is these quarter-over-quarter results are showing a serious deterioration in banking, and that's not what you want to buy into.
And Steve, I want to bring you in here because obviously we're seeing a lot more tech companies getting into this space, notably when it comes to Goldman Sachs, helping Apple with its very high interest rate accounts here now, and essentially more than what they would get if they were with markers. What position is Goldman Sachs putting themselves in right now?
I don't know, because I have a Marcus account, and I was quite happy to see that they raised my rate, only to find that I'd be better off if I had it at Apple. Goldman, it's a tough time unpacking that specific strategy. I understand why they want to broaden their customer base. I mean, they've always had a very rarefied customer base, which has served them well. But so far this has not been. The consumer has not been in their wheelhouse, and they haven't figured out how to monetize it. It's been a money loss for them, and I'm sure it's a huge distraction. And so. Apple, of course, having, perhaps one of the greatest customer bases in the world, fully locked into their ecosystem. I understand it, but I'm at a bit of a loss to explain why they would, give 25 why they basically would lose 25 basis points or forego 25 basis points for someone else to white label their offering. Doesn't make a lot of sense to me, but again, I've been a bit mystified, but I will say as a consumer, I've taken advantage of some of their high rate products.
Well, exactly. I'm sure the customers everywhere are smiling about that. A big thank you to our guest, Interactive Brokers Chief Strategist Steve Sosnick and Odeon Capital Group Financial Strategist Dick Bove. Thank you for joining us this morning. All right, well, China's economy is starting the year off strong. Its GDP grew by 4.5% in the first quarter, its fastest pace in a year as it shakes off pandemic-era trends. Now, this data puts China on the path to meet or surpass its GDP growth target of about 5% for the year. Now, Brad, this is an interesting one here. Obviously, we sometimes tend to take these with a grain of salt and given what goes into the GDP numbers as well. But in terms of where expectations were then, how should we be really reading this?
Yeah, there's a few ways to read this. One is from perhaps the way the IMF would look at this, and particularly with the targets that they had set forth, the IMF had already been looking for China and India to really be the two kind of tailwinds, or at least the biggest gainers here over the course of 2023 from a GDP perspective and economic growth. And here's what they had also noted earlier on in the year. When China's growth rate rises by 1 percentage point, growth in other countries actually increases by around 0.3 percentage point. And that's according to their staff analysis. So this really goes to show how other economies also benefit when China does grow. And of course, it's come on the back of them really reducing some of the COVID era restrictions, the no COVID policy, essentially. And so with that in mind, there's also the way to look at this from the investor standpoint. And if you're thinking about, all right, is there a way to continue to look at or at least evaluate if there's a trade in this resurgence within the China economy over the course of 2023. One of them could be in the form of e-commerce. We've been tracking shares of companies like Alibaba. Alibaba, even though we know that they're going to be going through their own kind of breakup of their business into 6 different units. As of right now, shares moving higher on this data pre-market by about 2%. You can also look at some of the other e-commerce players like a JD.com up fractionally here pre-market as well. And it also comes at a time where China has moved off of some of their more regulatory and restrictive measures towards some of these tech companies too, though you could argue whether or not some of the breakup within Alibaba was as a result of some negotiation with the country. But, you know, aside from that speculation, I think there is still a large way for investors to continue to evaluate where there is, for U.S. companies, even some exposure into China. Companies like Tesla, of course, netting new contracts to build out more of their production capacity on the megapack front. That could have a boon for the EV side of their business as well. And so a few different ways to think about this going forward, Rochelle.
Indeed, and when you look at what we saw with retail spending, we saw that retail sales really leading the way here in this GDP growth, led by a 10.6% year-over-year increase. A lot of us were wondering, you know, when China, you know, does lift these COVID restrictions, how strong is the Chinese consumer story going to be? And not only that, are they going to be spending more domestically, or is this an opportunity for some of these multinationals, especially some of these luxury companies, which have really been looking to China for growth? Is this now their opportunity to really capitalize on that? So obviously we're still seeing these early signs that China is on track, and a lot really riding on what happens with China's rebound. A lot of these estimations about how some of these tech companies fare is really based on this boom that they're expecting from China growth. And even as the IMF predicts where growth is going to be, a lot of that global picture was tied into a China rebound. So certainly a lot at stake here, and still very early days, but at least promising for the moment. But we will be breaking down more of the numbers later on as well.
Yeah, spot on. All right, we're going to continue that discussion here, but we got to switch gears here. And why? Well, tax day is finally upon us. As we mentioned, this is the playoffs for the IRS. And if you have not yet filed your taxes, you have until midnight tonight to do so. If you want to request an extension, you'll have until October 16th to submit your return. And if you don't file by the deadline without an extension, you could face a hefty penalty. The IRS's failure to file penalty is 5% of unpaid taxes for each month that you don't pay, up until 25%. We'll break down everything that you need to know about filing and extensions later on in the show. Switching gears now, though, to our dive into Yahoo Finance's latest morning brief, and we're taking a look at the implications of artificial intelligence. AI may be opening new doors of opportunities in tech, but not without rattling up the status quo in the search market here. And there's a lot to really break down here, Rochelle, especially as we think about what type of monetization this could lead to for companies who are still awaiting for more regulatory or regulation rather to come forward, and a question of whether or not regulators fully understand artificial intelligence to the extent that they're willing to or want to take action around it right now.
And it's interesting, we're seeing this sort of stop and start reaction from a lot of the CEOs as well, whether it's Sundar Pichai or Elon Musk, saying they're really at the forefront of some of these advances and incorporating it into their businesses, but also calling for more regulatory approval, really calling for some of this slowdown. But it's really going to be the search engines, which I think are going to be leading the way here. This is that easier path in, as we're seeing with Bard and we're seeing with ChatGPT being incorporated here. But it's really trying to make that balancing act of advancing this. Everybody wants to be first, but nobody really wants to draw the ire of regulators as they still struggle to catch up and really get a handle on this. So it's this sort of stutter stepping that we're seeing, but nobody wants to be left behind at the moment, Brad.
No, nobody does. And that's why we see all these new names coming about that we got to remember, whether it's Ernie, whether it's Bard, or whether it's whatever ChatGPT is going to be named. Does ChatGPT have a real name yet? I don't know if we've discovered that yet.
None of them really roll off the tongue. And then you have Truth GPT, which is Elon Musk's advancement coming into the way as well. There you go. Well, as advances in artificial intelligence continue, the hurdles in approaching AI regulation comes into question as the implications of such actions can spread far and wide. Here to discuss is Nina Schick, author, advisor, speaker, specializing in generative AI. Good to see you, Nina. So as we look at the pace of development that we've now seen, just even in the past year, especially when it comes to generative AI, where are regulators in this? They seem to be relatively quiet.
Regulators are far behind, because I think the first point to make is the AI that's seizing the market right now, that everyone is trying to get ahead of, that all the tech companies have pivoted to, so-called generative AI. I mean, it really only kicked off in the last 6 months or so with the release of ChatGPT and some foundational models before that. And the acceleration both of the technology and its applications are unprecedented. So when it comes to regulating this new space of AI, regulators are far, far, far behind. However, there's an increasing understanding amongst regulators, amongst policymakers, that they have to look at this. I mean, ChatGPT alone is the most popular application of all time. It had 100 million users within 2 months. There is no way that regulators and policymakers don't start looking at this field when you're talking about technology that is as popular as this, used by hundreds of millions of people, that is absolutely going to transform everything within months.
Nina, what does it tell you that Elon Musk, a person who invested in OpenAI, is now sounding the alarm on it, and other tech executives and CEOs are also kind of sounding some warning signs, if you will?
Look, it might be a case a little bit of cognitive dissonance, because whilst Elon Musk was a signatory to the AI moratorium letter, warning of the so-called kind of AGI scenario, the nuclear scenario, the moment when the machines become more intelligent than humans and take over. I mean, we are definitely not there yet. That is a possibility, the robots taking over scenario, but we are definitely not there yet. And how do we know that? Elon knows that too, because I think it was just weeks or days after signing that letter, he is gone all in on generative AI. He's launched his own venture. He said he's going to build a competitor to ChatGPT. So on one hand, whilst I think these kind of tech titans are not disingenuous about these potential existential risks, I think they're also too smart to know, too smart that they know that this is not coming right now. And right now it is about getting market share, about building the platforms, building the enterprise models, building the foundational models that are completely going to transform the way we work in the market. And everybody wants a piece of that. Google, Microsoft, Amazon, I bet you Apple wants a piece of that, and Elon is not going to be left behind.
So then, Nina, from a regulatory perspective, obviously as we await Skynet to become a real thing, what are some of the most immediate dangers and perhaps some of the regulations already on the books that could address some of these immediate dangers?
I mean, from a regulatory perspective, I wouldn't want to be a regulator because it is so vast. It's like saying, okay, regulate the economy or regulate the internet. How do you even address something as huge as AI and begin to regulate it? I mean, first of all, is just the conceptual understanding of what's happening, which is extremely difficult because as I've been researching the field of generative AI for the kind of past 5 years, kind of starting at ground zero, I've seen how quickly these technologies are advancing, where even researchers, the people kind of in the very kind of cutting edge of this, are surprised at what the tech can do now and how quickly it's expanding. So regulators are always going to be a step or two behind. That being said, I think the predominant concerns right now that are coming to the table have to do with data, have to do with IP, have to do with privacy, and have to do with ownership, not only of these models, but also ownership of who gets to have what the AI generates. And I think this will be very, very important going forward. We've seen that in Europe, some kind of opening salvos from the regulators have been fired, mostly by kind of banning ChatGPT temporarily, like they've done in Italy, or saying they're going to be looking around some of the data protection issues on the training data for ChatGPT. But these kind of use cases, or these cases, will have really profound impacts for the entire field of AI and machine learning going forward. But regulators have a huge job on their hands, because fundamentally the question is going to be, how do we regulate these systems and the companies that are building or have access to these generative models in a way that does not stifle innovation? Because I think by going the way perhaps that seems to be a little bit the trend in Europe, where just saying we're going to ban this, I think you would be making a massive error because tremendous abundance is going to be engendered by these AI systems and models. So how do you regulate whilst trying to make sure that innovation isn't being stifled?
Nina, we only have a couple seconds until the opening bell here this morning, but if data is the currency that social media platforms were looking at and then being able to monetize that currency by further indexing the data that they were able to intake and see these massive profits, what is the currency of artificial intelligence from your perspective?
Well, data is a huge part of that, obviously, because they're these foundational models, which are kind of non-task specific, can almost do anything without fine tuning. And again, we're only at the very beginning, these models are going to get better. They're all powered by data. So who owns that data? Who owns the output? These are all absolutely integral questions for the future of artificial intelligence.
Nina Schick, who is the author, advisor, speaker, specializing in generative AI. Nina, pleasure to speak with you again and get some of your insights.
Great to be here. Thank you.
Thanks. Everyone, you were just taking a look at the opening bell on Wall Street. It is Tuesday, April 18th here, and when the clock has struck 9:30 a.m., you know what that means. It's time for the opening bell. It's already run. We had a look at the NYSE. There's a look at the U.S. major averages, the Dow, the S&P 500, and the Nasdaq. The Dow opens the day flat, just barely to the downside right now by about 3 points. The S&P 500, you're seeing that in positive territory, though. That's holding on to gains of about 0.4%. Nasdaq Composite up 0.6%. We're going to have much more on the early tape here on the day, plus some of the shares that we're watching. J&J, of course, one of them. After the company, they raised their full year guidance. We're going to break down those numbers next. Welcome back, everyone. You're watching Yahoo Finance Live. We want to take a look at some of today's market movers, starting with Johnson & Johnson, ticker symbol J&J. We got it loaded up here on the screen for you. The company out with a beat on the top and bottom line while also boosting its full year 2023 guidance. We've got Yahoo Finance's Anjali Kamlani joining us here to discuss. Anjali, shares actually down on the report here today. What's taking place?
Well, there was a lot discussed, and as you can imagine, the company does have a few little blips on the radar, most notably the talc case, starting off there with the additional $6.9 billion that the company is putting into what it hopes will be the agreement for the settlement with the plaintiffs through its bankruptcy and reorganization procedure. They're expecting that to hit around mid-May, or at least move forward around then. So that's the loss that was reported. Meanwhile, they do have also Stelara, one of their older drugs that is going to be facing competition soon, facing some questions about whether or not the company is looking into M&A activity to help boost its pipeline. CFO Joe Woke said that their eyes are always open, but as of right now, the company is sitting on a decent amount of cash and can pretty much, quote, do whatever it wants. So those are some of the questions that the company faced from investors. Meanwhile, as you mentioned, strong outlook for the company, significant boost from the med tech side with the pickup of procedures in hospitals around the world as the pandemic has been easing. They've seen that pickup. It's also been one of the stronger quarters for that segment. Typically, you've seen the consumer business sort of buoy any losses on the med tech side, but that consumer business, as we know, is the one that's being spinned off into Kenvue sometime this year. So that's also something the company is dealing with. Important to note that the talc case is not going to follow into that consumer business, but as it stands right now, just a lot going on with the pipeline. And importantly, some of the strong points on the pharma side, specifically from newer cancer treatments and multiple myeloma drug Darzalex. That's where the strength for the company is coming from today.
All right, thanks, Anjali. Moving on to Nvidia, growing artificial intelligence business that seems to have caught the attention of HSBC, the firm upgrading the chip maker to buy from reduce, noting Nvidia's incredible AI pricing power is not fully priced in. I thought this was interesting because there had been concerns about a slowdown in their data centers and the rising inventory levels, but this at least seeming to offset some of that. It was outpacing the S&P's daily gains yesterday, and as you can see there, the stock is up more than 2% on the day, so we're clearly seeing that also. Still in positive territory here. Still some room to grow here. Investors seem to be pretty bullish on this at the moment based on the AI prospects, Brad.
Yeah, a rare admission by an analyst of perhaps having an initial wrong read on this. They said in this client note, overall, we believe we were too cautious on Nvidia and believe that there's more earnings upside versus market expectations in fiscal year 2024 and beyond. What's particularly interesting to note as well around Nvidia is how much they played up and talked about the introduction of DGX Cloud, which is really that AI play, the artificial intelligence play for Nvidia going forward from here, and how that can really add in or layer in different language learning models onto that cloud and how that cloud can better process that. And so the number of companies that, of course, Nvidia already deals with in the data center business perhaps can be kind of immediate, at least experimentations within that DGX cloud. However, the DGX has been around for a little bit. This is just more of them layering in that artificial intelligence play onto it. So that particularly noteworthy for this company and Nvidia. The year to date has seen quite the bounce back, up by now 90% over the course of 2023 here, Rochelle, as well. Also here, tracking Lockheed Martin this morning. They topped analyst estimates in the latest quarter as supply chain issues slightly improved. The aerospace company also reiterating its full year 2023 financial guidance and expects free cash flow of at least $6.2 billion. Shares here this morning are up by about 3.25%. Just a few things that caught my attention within this report. Number one, they said that they remain on track to achieve their full year 2023 financial guidance, continuing their approach to returning capital to shareholders, $500 million in share repurchases, $784 million in dividends that were distributed during the first quarter here. And then I'm not going to act like I'm an expert, Rochelle, in anything geosynchronous orbit infrared sensing satellites, but this is something that's important to Lockheed Martin. But in terms of the Q1 net sales, 3 of the major divisions for them did see declines year over year.
I mean, and when you figure about Lockheed Martin's role in supplying some fighter jets, F-22s and F-35s to Ukraine, they were a heavy supplier of missiles and other military equipment in Ukraine's fight against Russia's invasion over the past year. So still continuing to see that, obviously, as the conflict continues in there. But looking ahead, it's interesting to see their forward-year guidance where they expect things to go. Obviously, we're still not seeing any reduction in the conflict there. So at least for now, you can see the stock still at least enjoying some gains, up more than 3% so far this year.
Yeah, great note there indeed. All right, everyone, coming up on the other side of the short break, Ford is unveiling its new Lincoln, and it comes with a new announcement. Supermanian has the details next. Welcome back, everyone. A big announcement from Ford coming in last night. The company will be importing its next generation Lincoln Nautilus from China to the United States. This is the first time Lincoln will import a vehicle from China to the U.S., and our own Supermanian has all the details. It sounds like a landmark movement forward here.
Well, it's a couple of things here, right? So the car, I saw the car last night in New York City. They had an event both here and in China for the Shanghai Auto Show. Car looks great. It looks like a kind of a bigger, almost like an aviator style, very long. So it's not a three-row SUV. Inside there's a full, I'm not kidding, the digital display across the entire dash.
Wow.
Very cool stuff. Now, the China stuff. The original Nautilus was built in Canada at a plant, in Ford plant there. They're retooling that plant to build EVs. So in the meantime, they decided to build the car in China. Now, a lot of advantages there, right? Building the car in China. It's cheaper. It's a big market for Lincoln in China, so they can keep domestic production there for the Chinese. So Lincoln probably thought to themselves, we can make this car cheaper-ish. It's a brand new design. We have state-of-the-art facilities there in China to build these cars, so that's why they're doing it. Now, of course, the UAW not happy about that. They think it's sort of, being stabbed in the back because of this. So there's a lot of political play here, but the car itself looks good. I think it'll probably sell pretty good. It's going to probably start around $50,000 for that car, and it's got a lot of tech, and sort of shows us kind of the direction of where Lincoln's going when it goes full EV eventually.
And I'm always on the hunt for the next EV or the next hybrid there. Not a horrible price point, considering what else is out there. But I want to talk to you about the electrical vehicle tax credit. Now, that list is in, and only 10 cars are actually eligible for the full credit price. So tell us about that.
Yeah, with the new battery requirements coming online starting today, actually, the list of cars available for the full EV tax credit has been whittled down to 10, like you said. And if you see the cars here, for instance, the Model Y, the Bolt, the Blazer, Equinox, Silverado, 3 of those right there aren't even on sale yet. They're going to be on sale later this year, the Equinox, the Blazer, and the Silverado. Also adding the Pacifica plug-in hybrid, Lincoln Aviator plug-in hybrid, along with the Lightning, the Lyriq, and the Model 3. Those are your cars. And it's only the Model 3 Performance, not the Model 3 rear-wheel drive that's getting the full tax credit.
I mean, that's a short list. I was expecting more. I was expecting, to really take advantage of that. But that is a very, very short list. A big thank you there to Yahoo Finance's Pras Subramanian. All right, coming up, how to invest in tech ahead of earnings. We'll speak with an expert next.
Turning now to our chart of the day. Bonds seeing a bump on bearish sentiment here. This is according to Bank of America's Global Fund Manager Survey. The report says that investors are shifting away from riskier equities and into a more risk-off approach. One contributing factor, credit access fears lingering despite the recovery from the collapse of regional banks like Silicon Valley Bank and worries that a downturn or recession continue to grow here. And so taking a look at our chart of the day, you're taking a look at the net percentage overweight equities versus bonds here, and particularly a few factors, one of which that we just outlined here, but another, especially as we're in the throes of, or at least the early moments of earnings season here, going to be interesting to see where some equities may catch a little bit more of a bid, given that you have a little bit more, at least for the next couple of weeks, a more muted Fed, and you're going to hear a lot of the tech speak start to come forward, especially over the course of Netflix earnings, Tesla earnings, and then even further as we get into some of the social media companies as well. But given more of an appetite or at least an inclination to kind of get a sense of what a consumer is spending on right now and where that is still dovetailing into some of the core elements that make tech companies so profitable at the end of the day. That might be interesting to track here, especially given the bounce back in tech. But again, I think versus the bonds out there, that's just been kind of a no-brainer type of play that some have enacted in their portfolio.
I mean, it's true. People were looking for a safe haven. I mean, this is essentially going to be one of the best telegraphed recessions that we've ever seen. And then you add to that added credit crunch that people are expecting from the banking crisis. And Michael Hartnett commenting in that note saying, if consensus lust for recession isn't satisfied in the second quarter, the pain trade, where people get caught off guard, would be a rally in bond yields and bank stocks. And some of the biggest tail risks, the credit crunch, global recession, and inflation as well. So really causing that push that people are, they don't want that risk right now. They don't want to take a chance. Even as the Fed could at some point pause this year, a lot of people are still taking this more defensive stance and not wanting to take as much risk at the moment, Brad.
Yeah, absolutely.
All right, well, let's talk about turning a profit in the tech titan clash. AI is attracting billions of dollars in investments from big names like Microsoft and Google. Battle lines being drawn even as tech earnings are just around the corner. So let's take a closer look at how to position yourself in tech. Joining us now is Kenny Polcari, Case Capital Advisors Managing Partner. Good to have you on the show here. So for people who are, they've seen what happened with bank earnings, which may not be as reflective as what we could expect for broader earnings. So how do you position yourself with tech right now before earnings?
So first of all, thank you for having me. Second of all, I think you have to be cautious broadly because I think the market's is still a little bit nervous and anxious. And so for me, I'm much more focused on mega tech, right? I'm kind of staying away from the fringe stuff. So I'm focused on Apple. I'm focused on IBM, Microsoft, Amazon, those kinds of names in the portfolio. And I think those names will do fine. Google, certainly there's going to be, there'll be another issue about that concerning kind of what's happened over the last couple of days concerning their search engine and all that. But the other big names I would kind of stay involved in. I would buy on weakness. I would be careful. When it comes to artificial intelligence, there's lots of opportunity. You reported it yourself, actually, about Nvidia and the opportunity that they have. They just got upgraded. That stock's performed really remarkably well again this year and is up again today. I would look at other names like C3.ai, which is another artificial intelligence name that has come under some pressure of late just because there was a short story out there that I think is garbage. But one way or the other, I think there's an opportunity there. But I think you have to go in with your eyes open and figure out who you are and where you are on not only the life cycle scale, but on the risk scale.
Even as we're kind of taking a look at these names going into earnings season and just kind of waiting to see what type of tone they strike about the health of their consumer and pairing that with what we've heard from banks right now, what most notably would you be listening for to say that these companies have made it through or are heading towards the other side of the larger declines that they had seen over the course of 2022, and that this rebound that we've seen in early 2023 perhaps has a little bit more of a rally to it or a little bit more legs to it?
Well, it's interesting you say that because J.P. Morgan's Marko Kolanovic just came out this morning and said he thinks the tech rally is overdone. And he thinks, that we should see a pullback in tech because it has gotten ahead of itself, considering we're still unsure where the Fed is going. Because remember, if the Fed continues to raise rates, high tech names and high growth names will come under pressure. And those really include a lot of the tech names, which is why, once again, I say I'm concentrated just in the mega cap tech names, because I think they'll weather the storm the best. But one way or the other, you can't compare tech earnings to like banking earnings because you just can't compare them, right? They're two different sets of earnings. And I think the banks, as we expected, came out strong, at least the money center banks. Maybe the regionals are going to have a little bit of a problem as we start to hear about them, considering, what happened with the Silicon Valley banking crisis. Now, from the tech side, I think you just have to be patient. And I think you have to stick to your plan. I think you have to know the names you own and why you own them and make sure that listen to on the earnings call and the forward guidance. Listen to what they say and make sure that the fundamental reason you own them or are looking to own them hasn't changed and it is still what you think it is. In any event, if it's a good quality name, even if it suffers some pullback, If it's a good quality name, it's coming bouncing right back. And I would view the pullback in any one of those names as an opportunity to add to my holdings and not panic and go, oh my God, Apple's down 10%. I got to sell all my Apple stock. I'm going to lose everything. You're not going to lose everything. It's Apple. It's like anything else. It'll have ebbs and flows. But as long as the story remains the same and is fundamentally strong, then I think you're okay. But you have to listen to the guidance.
So then who wouldn't make the cut here, Kenny? Who are you steering clear of in the tech space?
Well, listen, I don't own any social media stuff, right? So Meta, that stuff, I never did. I don't own it. I don't want to own it. Now, you could say, if you own Google, you're kind of in the space, but not really in the space. But I stay away completely from social media. I concentrate in those big names that I just told you. I'm also starting to pick away at the AI stuff because I do think, considering everything that's happening over the last 3 or 4 months and everything we've heard, certainly in the upgrade with Nvidia today, that AI is going to be a place that you want to be. But for me, the stuff I'm staying away from is just the social media stuff. I'm just not even interested.
Kenny, does tech lead the next bull run after a Fed pause or pivot?
Well, tech is certainly leading that bull run right now, right? You can see the Nasdaq's up almost 16% on the idea that the Fed is going to pivot. Now, here's the next thing. You have to decide whether or not you think the Fed is really going to pivot. I'm not in that camp. I don't see how they can raise up until May, then pause for a month and then start to cut. That makes zero sense to me. And so therefore, I'm not betting on that. What I am betting on is that the Fed is going to pause and then just hold rates where they are. If that's the case, then tech should do better. If we start to see the inflation data start to tick up again, forcing the Fed into another position to raise rates, tech is not going to like that, and investors are going to take money out of tech because they're going to run to take money out of the sector that has outperformed. Clearly, that's tech and a bunch of areas in tech. That'll immediately come under pressure. But if the Fed pauses, which I think that's what they're going to do, and hold rates steady, I think the cuts come in 2024, and then I would expect tech to continue to perform well.
Kenny, just lastly, while we have you, you were mentioning AI a moment ago. Is cybersecurity the most investable part of AI at this point?
Yes, I'm big in cybersecurity. I think you have to be CrowdStrike, Fortinet. You can even do it in the ETF CIBR. I think you have to have cybersecurity as part of your portfolio. Well, how much you weight it, once again, is going to be dependent on who you are. Younger people, your generation should be, in my mind, more overweight in cybersecurity. I'm at the end of the game here, right? I'm on the 17th hole, so I've got a lot less time than you. So while I'm in cybersecurity, I'm not going to weight it as much as you are. You have much more of an opportunity to take advantage of the time than I do.
Well, Kenny, one way or another,
yes.
I'll catch you at the 19th hole. How about that?
I can only hope.
Kenny Bolkari, who is the Case Capital Advisors Managing Partner. Thanks so much, Kenny. Appreciate the time.
Bye-bye.
Alrighty. Coming up, a mixed picture for the housing market. We'll speak with an economist from Moody's on the latest housing data. That's next. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Rochelle Akufo. Julie Hyman has the day off. We're taking a look at markets here as we strike the top of the 10 a.m. hour in just a few seconds. 30 minutes into trade, and the Nasdaq Composite, you're seeing that hold on to gains of about 0.3% right now over the past, we'll put this on kind of a 2-day scale just to kind of make it more week to date for you, if you will. In the 2 days, we're up by about 0.6% here for the Nasdaq Composite tech-heavy average. The Dow Jones Industrial Average, you're seeing that lower here this morning by about 0.3%. We'll give you a look at some of those names that are moving within the Dow components in a moment. And then the S&P 500, you're seeing that that higher by about 0.2% at this point in time. Over the past 2 days, still net higher by about 0.5%. Also taking a quick gander at the Dow 30 components, as I had kind of teed up for you there a moment ago here. We'll take a look at some of the biggest movers here on the day. It's actually Goldman Sachs off of their earnings report that's pulling up the caboose here right now for the Dow. Right now it's down by about 3.2%. Biggest gainer though, Apple, AAPL, mega cap tech company, moving higher by about 1% on the day here. And then CRM, Salesforce, also leading some of those gains for the Dow Jones Industrial Average. And very quickly, we'll ride out with a look at the 11 S&P 500 sectors. Technology leading the charge, that's up by about 0.6%. However, you've got some declines in the form of healthcare. That's down by about 0.5%. J&J, one of the health reports that had crossed this morning on the earnings front here. So we'll continue to track those shares as we move on throughout the rest of the day. Rochelle.
Indeed. Well, we have a housing sector health check this morning with single-family housing starts for March coming in 2.7% above revised February numbers. Building permits also out this morning, falling sharply in March. For more on the state of the housing market, we're joined by Moody's economist Matthew Walsh. Matthew, thank you for joining me. So this week, we're obviously getting at least a sense of the tone of what's happening in the housing market at the moment. What are your biggest takeaways from the data we have so far?
Yeah, thank you for having me. It's great to be here. I think the biggest takeaway right now is that, we're at a bit of an inflection point in the housing market. The construction data is always a bit noisy, but the trend is undoubtedly clear right now. We're seeing that, home building has stabilized. That began late last year, and we're definitely seeing that in the data. There are a few other things I think I just want to call out. I mean, the big thing is that February's data was revised lower. This was a seasonably warm winter, and that has largely affected the seasonal adjustment process. So, as expected, we saw February's data revised a bit lower, and it's definitely important to take this data with a grain of salt.
And so overall, we're still monitoring very closely where median prices are coming in at. Matt, what does that signal to you about where the broader housing market stands, given some of the recent notches lower or declines that we've seen on those average home prices?
Yeah, I think, we saw home prices come in a bit. They definitely are falling a bit slower than we saw the first half of last year, or the middle half of last year. The declines are largely due to affordability, which is still a really big problem in the housing market. With mortgage rates coming in slightly from where they were in October, they peaked just north of 7%. That has helped improve some of the affordability issues and brought some buyers back into the market. But just given the rapid pace of appreciation over the past 2 years, home affordability is still a major problem. And one thing that we look at here at Moody's is overvaluation, which is a great signal for where home prices will continue, where home prices can fall, and to the extent of which they'll fall over the next year. And while overvaluation is coming in a bit as median home prices fall, they're still very high relative to their historical values.
And so then how can we expect this to decline at some point? Obviously, you have rising interest rates. So if you're already an existing homeowner, you're not going to want to sell and have to take on higher interest rates. At what point will we see perhaps a sharper decline in some of these house prices, given the inventory is still so tight?
Yeah, that's a great question. I mean, for one, I think we're not expecting really sharp decreases. Certainly what we're going to see is nothing like what we saw in the last house price correction. We should see, a much slower decline than what we saw before, and even slower than what we saw in the first bit of this house price correction. We're expecting prices to come in about 5 to 10%, depending on the index that you look at over the next 2 years. One thing I think is important to note is, we're entering that spring home buying season. And while inventories are low right now, we should start to see inventories creep up as a lot more people decide to make the move. I don't think we don't plan to see any large increase in inventory. People are locked into those ultra low interest rates. But as more people decide to make the move, I think we can expect some increase in inventory levels over the course of the spring.
If we continue to have an affordability problem, how much does that continue to also trickle into the rent scenario and the calculus around where rent prices continue to moderate, especially in major metropolitan cities?
Yeah, that's another great question. I think, it's important to kind of break out the difference between the multifamily side and the single family side. While we still see, the single family side, particularly constricted in terms of availability of homes and availability of rentals, we're going to see this pretty significant increase in multifamily completions over the next year. Right now, we have a record number of units that are under construction, and multifamily compose a significant share of that. And as those units come online, we should start to see some of the high rents that we witnessed over the past 2 years come in quickly. I know recent data is showing some declines on rentals for the first time in quite a while, and that's on a year-over-year level. So, we are starting to see those rents decline a bit, and obviously that has major implications for the inflation picture.
All right. And Matthew, we have these home improvement stocks that are up there at the moment. A lot of people, when COVID first hit and they realized they weren't going to move, started doing a lot of home improvement. We did start to see that taper off. There's only so much improvement that you're going to do in your house over a certain period of time. What are your expectations there, and how much spending you think consumers are still willing to do on home improvement?
Yeah, that's one thing that we're keeping a close eye on here. I think as the housing stock gets older, we'll definitely see a lot of spending on home improvement. You have a lot of people who are kind of stuck in place right now just because there are not so many homes available. And people are locked into these low rates. So they are choosing to invest in their own home because they're in a way forced to stay there. So they're taking some of that money that they would spend on a down payment that they maybe can no longer afford and invest in their current property and spend on renovations. Or remodeling or things like that.
Matt, the only improvements I can make right now to my apartment are in the air quality, so I just keep buying more plants. Moody's economist Matthew Walsh, thanks so much for taking the time here with us today. Appreciate it.
Great. Thanks for having me. Thank you.
Coming up, investors closely watching Netflix ahead of the earnings reports. This is coming after the bell today, but what are the analysts predicting? We're going to discuss this next. The streaming wars are heating up with Netflix set to report earnings after the bell, but how are analysts feeling? Yahoo Finance's Alexandra Canal joins us now for a pulse check on Wall Street. Ali, what is the street saying at this point?
So the street is basically saying it's not so much going to be about the actual results or the actual numbers, but more so about the commentary that we get surrounding the password sharing crackdown, in addition to that ad-supported rollout, which we saw in November. Those are two big revenue drivers for Netflix that analysts see playing out very positively in the quarters ahead, particularly in the back half of 2023 and heading into 2024. But there will be some short-term noise, especially as it relates to churn. JP Morgan was out with a new note this morning ahead of those results, and they demonstrated how some of that noise has already played out, with Google search trends peaking for the phrase cancel Netflix right around the time that the company announced the implementation of page sharing efforts, so right around January and February earlier this year. Now, because we haven't yet seen this crackdown roll out in bigger countries like the US and Brazil, I have noticed a lot of analysts on the street are revising their subscriber forecasts up for the first quarter and lowering them for Q2 in order to reflect any potential churn that could happen as this rollout continues to affect certain countries. Now, in a new note ahead of earnings, we heard from Wells Fargo analyst Steve Keyhall. He's a very well-respected media analyst on the street. He had this to say about the password sharing crackdown, writing, quote, U.S. implementation feels a bit delayed, but we think that will feed incrementally bullish comments from management about the sub/revenue opportunity. He added that extra member pricing, or the cost of adding more members to a user's account, will come in at about $8 a month in the US. That's obviously a big driver when we think about revenue upside in the quarters and years ahead. If we take a look at the stock, it's up more than 10% year to date, roughly flat on the year. Across the street, we're seeing 26 buys, 25 holds, and 4 sells, according to Bloomberg data. And options trading is implying a move of about 8% post-earnings. So should be a really spicy report that we get. And Brad, we're going to be breaking it down on after the call as soon as it wraps up.
I know. We were keeping a close eye on NFLX shares going into this as well. And even the options market right now pricing in about a 7.5% move, absolute value. Yeah. Going into this report based on some data from Options AI. I mean, I'm leaning on artificial intelligence to see even more of what this implied move might look like, Rochelle.
And I'll definitely be keeping an eye on it. Obviously a lot of people said they were going to cancel Netflix before that the password sharing crackdown even came to the US. I'll be interested to see if that actually ended up translating into anything ahead of that. But obviously a very crowded space here. So how is Netflix trying to differentiate itself from the streaming space?
I think the biggest thing for Netflix is its ability to lean on its global content. And relative to competitors, the company has really been able to deliver on that. We've seen a ton of international success, like Squid Game, and how great that has done for the platform. JPM anticipates that the platform will reach 300 global paying users by the year 2027, despite all these near-term risks surrounding churn. Another risk that's floating around Hollywood right now is a potential writer's strike. We heard from Late Shed Partners Rich Greenfield, who said because Netflix is so reliant on international content, and remember, those international productions, they don't have anything to do with the negotiations over here in the US, that could be a potential positive for Netflix down the line. And then obviously we've seen other initiatives from the platform, such as its foray into live events. Of course, that didn't quite work out with the live Love is Blind reunion special. That was a bit of a botch for Netflix, but if they can figure that out along with their gaming initiatives, I do think that's something that can retain those loyal subscribers down the line.
Everybody's favorite guilty pleasure.
Oh yeah, I just started it. I avoided it for a really long time, but now I'm obsessed. So here we go. But at least I'll be able to see the reunion special and not be disappointed.
You'll be able to watch it all the way through.
Exactly.
No interruptions. No interruptions. Rochelle, what about you? Love is Blind?
I've watched Love is Blind. I think I watched it to like halfway through and I was like, I don't know about this.
It's the weirdest concept ever. I think to myself all the time, like, could I do this? Probably not.
No.
We'll have to do it. We'll have to do a Yahoo Finance.
Nope, I'm done.
Come on, let's experiment.
Nope.
Yahoo Finance reality.
Was available for, declined to comment.
There you go. What could possibly go wrong? A big thank you there to our very own Ali Canal. Thanks so much. All right, coming up, Gary Gensler is back in the hot seat facing the House Financial Services Committee. The hearing just started moments ago. Will the SEC chair shed any light on crypto regulation? We'll discuss next.
Yahoo Finance goes live after the call. This time, we're zeroing in on Netflix. Ticker symbol NFLX. You know them, you love them, you watch them. Whether it's Love is Blind, whether it's Beef. Netflix has been the tried and true and battle-tested streaming content provider. What does that outlook for growth look like from this point forward, as they've already spent billions of dollars to get into your home and onto your screens as well? And so we're going to hear about what the subscriber counts are right now. We're going to hear about how their international presence has continued to expand. We're also going to hear a little bit more about their own inclination to continue to add on to the different types of features that they've already put into the platform that could perhaps widen out that customer base at the end of the day. So before you tell me exactly what your favorite Netflix title is, I'm just gonna let you know that we're gonna be tracking all things Netflix. After the call ends, that's when Yahoo Finance begins. We go live and we break down the tick by tick for you on the Wi-Fi Interactive with after hours trading moves as well. Tune in after the call, NFLX Netflix, you know what it is.
House Republicans turning their scrutiny on the Securities and Exchange Commission. Under review in a hearing today, SEC Chair Gary Gensler's moves to regulate crypto and proposals for climate change rules. Here with more, Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Good morning. That's right, Rochelle. SEC Chair Gary Gensler on the hot seat right now before the Republican-led House Financial Services Committee. In a hearing that House Republicans have been sharpening their teeth for months now, Committee Chair Patrick McHenry and other Republicans are laying into Gensler for overreaching on his ambitious regulatory agenda and for being unresponsive to Republicans' pleas for more information. Right off the top, Chair McHenry told Gensler to, quote, get comfortable, that today they are going to cover a lot of ground. He accused Gensler on refusing to provide clarity to crypto firms on what constitutes an investment contract, saying he's punishing companies for not complying with the law but aren't providing clear rules of the road. McHenry lambasted Gensler for not responding to congressional inquiries for information, practically threatening to subpoena information from the SEC if Gensler does not provide it. Now, Ranking Member Maxine Waters said it was unfortunate that today's hearing is happening because Republicans have threatened to, quote, do a big number on the SEC and Chair Gensler, and today is the start of them doing good on their promise, while Representative Sherman commended Chair Gensler for standing up to the, quote, crypto bros. Now, Republicans are expected to focus mostly on crypto and newly proposed climate change rules questioning. Ahead of this hearing, committee Republicans sent a letter to Gensler, Republicans slamming the SEC's approach to crypto regulation and attempts to push exchanges to, quote, come in and register. They really want Gensler to work with Congress on customized new rules for crypto. Gensler defending his agenda and opening testimony. He will say in his remarks on crypto that nothing about the crypto markets is incompatible with current securities laws, reiterating that the vast majority of tokens are securities. He says, quote, it's the law. It's not a choice. Calling yourself a DeFi platform is not an excuse to defy the securities laws. Right now, unfortunately, this market is rife with non-compliance. On proposed climate change disclosure rules for public companies, a move that McHenry says is an excuse to push progressive views on the American public. Gensler says hundreds of companies are already doing this. So we just want investors to be able to get more transparency on this and make sure there's a uniform way for companies to comply with this. McHenry says this is the first hearing of what will be many hearings this summer as Republicans try to come up with a regulatory framework for crypto. Guys.
All right, thanks so much. Our own Jen Schonberger. Jen, appreciate the updates there and tracking all things coming out of this hearing. Appreciate it. Coming up, everyone, we've seen a lot of bullish takes on Meta ahead of the company's earnings report, but our next guest says not so fast. He'll explain the biggest headwinds the company faces going into the next quarter. That's coming up. Shares of Meta are up over 80% year to date as big tech bounces back. But our next guest says that he's taking the opposite stance to Wall Street on the tech giant. Arete research partner and senior analyst Rocco Strauss joins us now. Rocco, great to have you here with us. Help us break down your thesis and why perhaps some of the bullish sentiment around a more cost-conscious Meta might be overblown.
Yeah, I think you have to split this into the cost side and obviously the top line expectations here. I think the cost side is somewhat understood by the market, given that Meta has already lowered its OPEX, by roughly $3 billion or so at midpoint. So I see limited downside surprise potential to this and would flag a handful of reasons why EPS expectations actually have gotten a bit ahead of themselves. So first, Meta is becoming a structurally lower margin business, with Reels increasing its share on time spent. Think especially about the creator costs that you have against that here. Second, Meta seems to offer more discounts, and that's according to our checks with advertisers, especially to attract more experimental budgets onto Reels, though on the cost side, that's not favorable. Third, the hardware share, mainly driven by Oculus, is rising, and that's a lower margin business. And we have, on top of that, seen some large discounts already for these VR kits. Fourth, you see Microsoft and now even Amazon, Twitter, and a few others accelerating their AI investments and partnerships. And Meta certainly has to double down on this during or within 2023 as well. And then lastly, the ongoing ID issues referring to Android's SDK runtime, which is somewhat similar to what Apple did with ATT last year. The prevention of fingerprinting workarounds and others could further deter proper attribution in 2023. And that certainly would weigh on pricing and requires more investments into measurement. That's the cost side.
And so, Rocco, I want to break some of that down because you mentioned, obviously, better engagement there. There was a lot of hubbub about, with the TikTok ban, who would be the biggest beneficiaries, but it seems like investors got a little bit ahead of themselves. What's the scenario you see there regarding what happens with TikTok and how that might impact what happens with Meta's growth?
Yeah, I mean, it's really the question, are we seeing an outright ban of TikTok? And that certainly could, on a run rate basis, depending on when that ban actually happens, add some like $4 to $5 billion or so to top line in this year. But it could also be that we are going to see some kind of divestiture, or someone is actually acquiring the Western world TikTok assets, and that certainly would have little to maybe even a negative impact, given that more budgets could actually move to TikTok in a more brand safe environment than under the current owner.
Has the bottom in terms of some of the digital marketing revenue sentiment, has that bottomed out?
I think it's two key things that we should look on here, right? I mean, ad checks somehow kind of like point to some stabilization in first quarter of 23 versus fourth quarter of last year. Though let's think for like a quick second about how inflation is actually driving this, right? I mean, core inflation only peaked in March of 22. Thus, there is some support still in January and February of this year, while that will fade from second quarter onwards. That's the first thing I would flag. And then secondly, the street is projecting a huge reacceleration of top line growth in second half of 2023, mainly citing lower comps. I would raise a key question here, and that is what is putting the consumer in better shape in second half of 23 versus second half of 22? Given we see intensifying macro challenges, with the looming credit crunch, sticky inflation, record level credit card debt, you have rising mortgage rates, you have increasing unemployment likely in the second half of this year. And that should put a lot more pressure on ad budgets in second half of 23, where the street sees some 10% growth for Meta, while we actually project a decline.
So then, I mean, a lot of this is, we saw a lot of optimism when Meta first announced this year of efficiency. We saw, multiple rounds of job cuts, more expected on the way as well, and really also pivoting away from some of the less profitable aspects of the business. But do you think investors then aren't focusing on the right things when they're focusing on this year of efficiency?
I guess the question is, are you looking at 2023 or are you looking, already beyond what may happen in 2024? I think 23 is a lot more challenging than what consensus estimates currently project, right? And certainly we shouldn't turn a blind eye, as you point out, on the disruption that could be caused by these layoffs. I mean, while Meta certainly wouldn't cut headcount by now 21,000 people in total, as sales were actually soaring, or if the company would assume a huge reacceleration in second half of 23. And then maybe if we look a bit left and right here as well, right? I mean, Snap had a lot of issues around its App Store business driven by Apple's privacy changes. Pinterest suffered from a lack of innovation, also the dependence on brand spend. While Meta is still, even today, a supply-constrained platform, though the queue or bench of advertisers has been thinned out over the last some quarters, which you see reflected in lower CPMs across the board. And while the e-commerce budgets that are sitting within Facebook and are likely driving some 45% of the total mix are driven by SMEs and D2Cs, are just fading with falling discretionary budgets, we are just seeing that starting, given that most consumers have actually burned through their COVID savings, and that will certainly have an impact into the second half of this year as well.
Okay, and so going forward from here for Meta, the larger question is, for some of the advertisers that may have left a platform like Twitter, even though we're not going to necessarily get quarterly or real cadenced reports from a company in Twitter, of course, common knowledge at this point in time is that they have struggled at least to hold on to advertisers at the same scale. Does any of that flow on over to a company in Meta and some of their subsidiaries?
Yeah, I mean, if you put Twitter in relation, obviously, to Meta, it's significantly smaller. So even, if you assume half of their ad budgets would flow onto the platform, it would almost not be meaningful for Meta. And then also the question is, where do these budgets actually flow? I mean, Twitter largely, was more B2B advertising, and that probably is better suited certainly on platforms like LinkedIn and maybe a few other platforms.
And so then if you had to give your estimation of where Meta is going to fare versus some of its counterparts here, facing the same macroeconomic conditions, but as you mentioned there, some issues at least for Meta on the retail side, how should Meta better position itself?
It's tough, right? And I mean, certainly these larger, ad-funded internet names have never gone through a recession so far. You can look back to 08, 09, 010, and what you have seen in terms of like how growth rates have behaved on Google at that time, and that shows you that you had a huge deceleration in growth, in 09. And these companies here are not immune of these cyclical downturns that we're actually running through. So there isn't really a lot that Meta can do. I think they're already early on, with all the headcount reductions that you have, as they are kind of seeing what's coming towards them in the second half of this year. So it is the right thing to focus on the cost side, while still investing in the right products to actually move out of this in a stronger position.
Hey, Rocco, just very briefly while we have you, has Meta gotten past some of the iOS privacy changes and the headwind, or at least kind of the knock on how much they were able to index data, how much data they were even able to kind of advertise based on?
Yeah, I mean, Apple has already opened somewhat, especially around attribution, which was like the main issue for Meta and also like some of the others here. But as I've already flagged a bit earlier, right, we should also not underestimate what's happening on Android. That is, like moving somewhat slower, but is going the same direction as Apple is. And also Apple and Android both are trying to prevent these fingerprinting workarounds of these privacy changes that we had seen. And that certainly could cause, trouble to everyone in this market. Though with a large first-party data set, as Meta has it, they're slightly better positioned than many of their peers, especially like TikTok or Snap, and they could benefit from that after you had some period of kind of like turmoil, if you want.
Certainly interesting there, flagging some of those highlights there. A big thank you there to Rocco Strauss, Arete Research Partner, Senior Analyst. Thank you so much. All right, coming up, China's economy getting a boost with consumers getting back to old spending habits. So how should investors play this? Maybe luxury, maybe ETFs? We'll get the answers on the other side.
Is the banking crisis over?
I hope so. It does feel like it's largely contained, and although they have their detractors, I think you have to give credit to the Fed and other authorities for the speed at which they moved. I think maybe the debate now has probably moved on to the extent that we're seeing the big bank, kind of small regional bank divide open up. And that's what this week's earnings will be so critical on.
We're not saying there's a banking crisis, but we have lived through a scare. So I think deposits are leaving the system. They're being attracted into money market funds by the 5% rates that are on offer versus the sub 1% you get at your bank. That predates SVB and the recent banking scare. So I think that's going to continue.
We think we are moving from the crisis phase to the stabilization phase. And I think as we move into earnings season, what we're going to see is trends that we expected to envelop as the banking crisis did play out, which is deposits, meaning deposit flows, deposit costs, and the mix of deposits changing from those that are non-interest bearing to interest bearing.
Do you think the crisis is over, or this might flare up again over the summer?
I think it's too early to say with any definitive knowledge. The place to watch is the mid-sized regionals, the PNCs, the M&Ts.
China's economy is gaining at a faster than expected pace. The country reported its first quarter GDP rose by 4.5% year over year, marking the strongest 3-month growth span since last year. China's economy is seeing benefits since lifting strict COVID restrictions and easing crackdowns on some of these large tech firms. Retail sales climbed by 10.6% in March, significantly beating expectations. So how should investors play this data? Well, let's bring in China Beige Book CEO Leland Miller. Leland, I first want to get your takeaways from this data, given the expectations going into it, and what you're really taking from this.
Well, it's a very interesting time to be talking about the economy because, for weeks we have been suggesting that markets have been too glum on China, that Q2 was going to be a much more significant cyclical bounce back than people expected. Our March data was better than our February data. So we see an economy reactivating. On the other hand, you look at the Q1 print, 4.5%. That's nonsense. They pull growth forward from the second quarter in order to make the first quarter look better. So people are getting energized a little bit earlier than they otherwise would. But I think the second quarter is going to look good. I think that you are entering a cyclical bounce back in China. So people are right to be excited. They're not, they probably shouldn't be taking much stock in the first quarter numbers, though.
What does this mean for some of the economies that also can benefit? I mean, the IMF, they were talking about, even within their projections earlier this year, the beneficiaries of when China's growth rate rises by 1 percentage point, growth in other countries, and what that leads to as well. So where do you expect this to also flow into other regions or even companies that are trying to operate in China?
Well, that entire idea is mostly wrong. Higher China GDP growth doesn't create growth in other countries. Trade creates growth in other countries. So if you see Chinese demand domestically jump, if you see the import numbers jump, then you can see where the recovery in the Chinese economy can really help neighbors and the rest of the world. The problem here has been that the import numbers have been very, very low for a very, very long time. It's been mostly an export story. So look, if this is turning around, if you do see strength from the Chinese consumer finally, then yes, there could be a benefit to the rest of the world. But the idea that Chinese GDP is going up and therefore the world is going to get better, that's a flawed conception.
Well, certainly that the IMF has been that narrative that they've sort of been toting, that China's growth is going to be what ends up lifting all the boats here. But I also want to talk to you about some of these multinationals who have exposure to China. Perhaps people who are saying, is this a good time to get in there? You're saying perhaps by the second quarter, perhaps the GDP and retail numbers might be closer to fact.
Well, yeah. Look, the second quarter numbers are all shaping up to be much, much better. You could see that in our data, just as the improvement as we got into a pretty weak Jan, Feb. March was much better. We expect April and May and June to be much better than that. But again, the big question here is what's happening in retail. You look at this number for retail sales in March, it got everyone excited. We're not seeing that level of strength. We're seeing improvement. We're seeing conditions improve in investment and hiring, et cetera. But the economy's not quite there yet. So if you do see consumer spending jump, even for 3 months, people are going to get very excited. The question is, can they have numbers that stay elevated for longer than 2, 3, 4 months? Structurally, that's going to be very difficult because of the impairments on the consumer in China. So we're going to see whether this is a 1 quarter, 2 quarter, 3 quarter growth story, or whether the consumer has more oomph.
Some of the story has been around the domestic reforms that have taken place and the moving away from the zero COVID policy. But what about on some of the international relations that China needs to also continue to foster or maintain in order to see growth? What would you be watching for there?
Well, I think what 2023 is seen is a real goodwill tour by Xi Jinping and the Chinese towards the Europeans. One of the issues here has been to head off potential coordination on export controls, but also there's been a message: China's open, come back to China. A little bit of that in Asia too. So yes, of course, China is trying to become a magnet for more foreign investment, which has not been the case for the last several years. But, this is a very tricky time because of rising geopolitical tension. So, there's a message there, but I'm not sure people believe it yet.
Does that goodwill start to run out when you see some of the military exercises that China had even put into kind of a drill fashion in recent weeks?
Certainly. Those are the rising geopolitical tensions. You've got problems with, export controls and sanctions on advanced technology. Everyone is looking very closely at the way that China interacts with its neighbors and the way U.S.-China tensions are headed. You don't want to go too big into China if you think that you're going to have pressure to try to get out. So, we're seeing a lot of companies go into China. They're very focused on the Chinese market, but they want to produce in China for Chinese consumers. The supply chains that run through China and then back out exporting to the West, a lot of people are picking those up and pulling those out because they're worried about geopolitical tensions rising in the coming years.
And we did see some commodities, oil especially, rising ahead of the launch of that GDP data. In terms of the commodities that you're going to be watching here, when you look at the demand story for China, what stands out to you?
Well, we track steel, aluminum, copper, coal. We also look at proxies for oil and other things. Obviously, we're going to be looking at how property recovers and how commodities recover. Is there a bigger oomph into the fiscal stimulus? And is there a bigger push towards pushing growth through building, which has been something they've done in the past, but not for the last several years. So we're going to be watching those commodities. We're going to be looking at oil, too, simply because everyone is so interested in whether the China recovery story is sufficient to sort of knock oil into the range of 100 or higher. A services, a retail recovery, that doesn't necessarily mean that oil is going to skyrocket in China. Manufacturing is not doing great. Property still troubled, even though recovering. So this is a question that's going to be a lot more easy to answer once you get into the second quarter.
Leland Miller, who is the China Beige Book CEO. Leland, thanks so much for the time and the insights.
Thank you.
Absolutely. And coming up, are you spending the night with your W-2? If so, you've got less than 24 hours to go. Way less than 24 hours now. Don't worry, we've got you covered. The biggest things you need to know to meet the tax deadline for this year.
The single biggest life change that drives the most tax changes is purchasing a home. Once you're a homeowner, there is no question, it's unequivocally clear you are no longer a simple tax return. You do need to know the basis of your home so you can calculate the accurate gain, so you can determine whether or not that it is a taxable gain or exempt gain.
Crypto is just like a stock investment if you are holding on to it as an investment. The way you use crypto is how it's taxed. When you're paid in crypto, that's going to show up on your 1099 form if you're paid as a contractor or your W-2.
There aren't a lot of changes going on right now with the tax code. Good news, the standard deductions are larger this year. The child tax credit, a little bit smaller this year. Also, the expansion of the child and dependent care credit expiring. So that's not good news.
Credits are dollar for dollar reductions in your tax liability. So if you lose out on a credit in 1 year versus the last, it can have a much more impactful change on your ultimate tax liability.
If you have a very complicated return, then you probably could be raising a red flag. But I think for most average people who are filing, they have nothing to worry about.
Getting ready for 2024, make sure that you're having the right amount of taxes withheld from your paycheck to avoid that end of year sticker shock.
It all comes down to this, folks. Today is the day taxes are due by midnight today. And even if you've snagged some extra time to file with an extension, you'll still need to pay anything that you owe today. Here with everything that you need to know ahead of the tax deadline, we've got Larry Gray, National Government Liaison for the National Association of Tax Professionals. All right, so Larry, this is it for a lot of folks. This is the, as we've been calling it, the playoff season for the IRS as well here. So first and foremost, there's been a lot of kind of question about how quickly the IRS would be able to move through all of the different tax forms that people are filing here right now. But there's been a lot of billions of dollars, actually. There's been a lot of capital that's been put towards the organization in order to really make sure that they've got enough personnel to do so.
Yes. The $80 billion, they just came out about a week and a half ago with the 10-year plan. And so it's from a 30,000 foot level view. And with that, I think we have to stay tuned and watch the implementation over the next couple of years.
And so what are the expectations as to how it's going to change the tax experience for users?
I think the big thing is they've got 5 objectives, and the first one is customer service. And I think through technology, we're going to see a lot more like the online accounts for the taxpayer be more convenient. I think you're going to see the Tax Pro account be able to assist that taxpayer much better. So I think pre-file and file, there's going to be a lot of benefit. I think there's going to be a lot of questions being able to be asked online. I think that with modernizing the IRS, a lot of their stuff is 50, 60 years old. And as a result, it's going to take a little bit to convert to a common platform. Many states have already done this. I think Minnesota, they went from like 50 programs to one platform, and it really allowed interchange. So I see for the taxpayer here in the near future, they're going to want to get their online taxpayer account, because they're going to start adding all these features. What's my advanced earned income credit? We had that. What did I do last year? W-2s, 1099s being filed. You'll be able to see those online. So I think you're going to see a futuristic in the very near future with this money is like a taxpayer dashboard. So you'll be able to go out and click instead of making a phone call and sorry, wrong line, you got to get another one. So I think in that light, the technology will work, but that'll also free up IRS assistance on the hotline, the online account, to where that more complex returns can be answered. I like discussing that because, I mean, even as we're here in April,
this is perhaps the best time to set up some new kind of standards for yourself and just how you can operate on a day in, day out basis with a mind on the 2024 tax season there. And so when you think about and when you tell some of your own clients about how they can set better practices, what do you advise them and how do you kind of set them on a better cadence to even get ahead of next year's taxes?
I think it's an excellent point. And again, I'm going to go back to this online account because as they build, like you get a notice, that in the future will be sent to your online account. And if the IRS will push all the data they have to that individual taxpayer account, then I can go and see not only where's my refund, but I can see, during the pandemic, the big thing is where's my return? Where is it in this backlog? And I think with this ability and the funding they're getting, that service could actually be, hey, your return's been e-filed. Here's an error. Can you correct it? It's been processed through, or like you said now, for this spring and summer after the filing season, if there's a notice or something glitched within the processing of my individual return, I'm going to know real time. So, and I realize this is a big stand-up, but I really truly believe by the filing season of 2024, especially the online account, is going to be so beneficial to everybody. It's going to be beneficial to my clients, but also it's going to help me instead of getting a notice, my client getting a notice in the mail, coming in and see me. I can actually have my online Tax Pro account and I can see that. So we can take care of issues as it moves through, whether it's the filing stream, the notice stream, even to the examination stream. So I think it's just going to be so much more convenient. You're going to see the number of phone calls to the IRS drop. It takes less staffing. So I just, in our own office for the last 2 filing seasons, we've actually had a computer out front where we've been assisting our clients to get their online account. And I think with this, I can't say it enough, with this $80 billion funding, how important it is for you, the taxpayer. Please get your online account because you don't have to go through a Tax Pro. But if the complexity sets up or you need somebody to explain it to, then you can go to your Tax Pro, who will also have the Tax Pro account where they can get a power of attorney and assist you real time, not through all this paper process downstream from filing a return.
Right. And so for Larry, though, for some people who have their back against the wall, the deadline is, hours away. What are the top 3 things they should do? Because some people are like, do I file and risk getting it wrong? Or do I just file for the extension? What are the top 3 tips you have for people?
The top 3, number 1 is if you have question on your return, get an extension and do it right the first time. Because if you don't do it right the first time, then we're going to get into that notice chain and delay any refund. So first thing is get an extension and do it right the first time. I think the other thing in doing it right is I see so many times we get to this, the 23rd hour and people try to push it and we get the information on the taxpayer and dependents. We get a Social Security number wrong. We get a bank account to put the refund wrong. We get, the dependent. Sometimes it's, the ex-husband one time, ex-wife the next time. So slow down, when in doubt, get an extension, do it right the first time, and then make sure all your documents are correct. And thirdly, we're coming out of the pandemic, and I'm again with doing it right the first time. And in this case, if I get a 1099-R or a sale of a residence, a 1099-S that I shouldn't have got, be sure it goes on the right form and on the right lines. And if you don't understand that, then you need to get professional help.
All right, Larry Gray, CPA and Government Relations Liaison for the National Association of Tax Professionals. Larry, thanks so much for the last-minute tips here. Appreciate it.
Well, thank you so much, and have a wonderful day.
Absolutely, you too. And we've got some great guests lined up all day today on Yahoo Finance. Inez Ferre will continue our coverage of big bank earnings with JMP Securities' Devin Ryan. You don't want to miss that.
Plus, tax day is upon us, and S4A will speak with an expert to break down the tax gap. That's also coming up in the next hour.
And stay tuned for After the Call today. Shauna Smith will join me to break down Netflix's earnings call. You're going to want to stay tuned for that for sure. Let's take one last look at the markets here. We've turned negative across the board for the Dow Jones, the S&P 500, and the Nasdaq. The Dow had been in negative territory to start off today's trading session. Trickling into that red, though, is the S&P 500, down by about 0.1%. Nasdaq also about the same on a percentage basis. And Nesferre's got you for the next hour of trading. Stay with us.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Ines Ferre. Here's what I'm watching. A tale of two banks. Bank of America beats the street on the top and the bottom lines, but CEO Brian Moynihan sees a mild recession ahead. We go behind the numbers with After the Call. And back with a bang, China's shoppers are back in force. And amid all that recession talk, Beijing is doing its part to help the global economy with strong GDP. We take a closer look at the U.S. consumer this hour. And the debate over how we measure economic output has been around for decades. So should we do away with GDP altogether or tweak how we measure it? We speak with a leading voice. But first, let's take a look at the major averages. All three major averages are slightly lower. You're looking at the Dow, that's down 0.3%. The S&P 500 hanging around the flat line. The Nasdaq also down slightly. And taking a look at where we're at with U.S. Treasuries, we are seeing the 5-year yield at 3.66%, the 10-year yield at 3.56%, and the 30-year at 3.78%. Let's dive into the bank results now. Bank of America seeing a boost in profit, largely from higher interest payments. The bank's net interest income jumping by 25%, matching performances at JP Morgan and Citi. But what happened on the earnings call? Yahoo Finance's Brad Smith has the details. Brad.
Hey, thanks so much, Inez. Well, lots to digest here from the earnings call, and I was able to tune in just before the start of our morning show. As it started at 8:30 a.m., Bank of America's CFO and CEO wasted no time getting into the story on deposits. Take a listen here.
Note the relative stability of checking deposits because these are the operational accounts with money in motion to pay the bills and everyday living costs for families. I'd also point out that our checking balances were modestly growing even ahead of March 9th upheaval and continued to move higher through the quarter on the back of disruption.
Consumers' financial positions remains generally healthy. They're employed with generally higher wages, continue to have strong account balances, and have good access to credit. As you think through all the tightening actions of the Fed, the flows to alternative yielding assets, investments, and the disruption of the past quarter, our deposits continue to perform well, ending the quarter at $1.91 trillion. If you think about it, that's about the same balances we had in mid-October of 2022. So we've seen these balances stabilize.
Now, Bank of America CEO Brian Moynihan also weighed in on the never-ending AI debate. Yeah, artificial intelligence, and going as far as to say it'll help adjust headcount down. Specifically, he discussed the growth and future prospects for the bank's Erica technology. Take a listen.
The key question will be, when can you use it without the fear of, the reason why a lot of us stopped it in our industry and other industries was it wasn't clear how it worked with your data and the outside world's data and how it would interact and pull stuff out, and we have to be careful of that. And then secondly, we have to understand how the decisions are made to be able to stand up to to our customers' demands for us to be fair and frankly follow the laws and rules and regulations on lending.
So all of this discussion, all of these words that they had to say on the call leads me to this for my vibe check. I'm going to say good, but I wish I had a scale here because there would be a lot of things that we would really have to look at here. And I think they struck a good tone for the bank itself. Of course, it is some of the larger bank here. Bank of America's CEO having some comments on the U.S. economy, and that means it's time for Wall Street versus Main Street, of course, in a moment. But at the end of the day, I think for the vibe that I was giving this and overall, what I was thinking about is where they're continuing to lean on their own projections of a shallow recession versus a more severe recession. And they did mention a mild recession over the course of the call. But if there's anything that they had to strike and had to get right among the investor community, it's where deposits were still holding up, where the health of the consumer was, which is where they said that spending is slightly lower, but still healthy, a term that we've heard over the course of the banking earnings that have really come at the former part of this particular earnings season and typically do during earnings season. And so that is something that I did pay close attention to, but really leaning on their projections that they had seen from their own internal group for a shallow recession beginning in Q3 of 2023 and not, at least at this moment, kind of worsening those projections. And so I think the street really latching onto that, and we'll see what more the company has to say about the health of that consumer as we get even more data in future quarters leading up to what could be the start of that recession, and we'll see how the markets price that in too. Rochelle Akufo, though, has the story on Wall Street versus Main Street, as I teed up a moment ago. Rochelle.
That's right. Thank you, Brad. Always love your vibe checks. Now, Bank of America's CEO striking a positive tone on the earnings call this morning. The overall picture, debit and credit card spending was slower, but healthy, they say, with 6% annual growth. They saw payments from customer accounts rise across all sources. The overall take from the bank, consumers' financial position is generally healthy. Brian Moynihan had this to say on the possibility of a pronounced slowdown.
We don't see the activity on the consumer side slowing at a pace that would indicate that, but we see, commercial customers are being more careful and things like that. But everything points to a relatively mild recession, given the amount of stimulus that was paid, to people and the money they have left over. The fact that unemployment still at 3.5% is full employment plus, and then the wage growth is slowing and tipping over. So the signs of inflation are tipping down, but they're still there, but that translates into good, relatively good activities.
Now, of course, any kind of recession will have a severe impact on the U.S. consumer. Worth noting the importance of this insight as BofA has a much bigger consumer lending business than, say, Goldman Sachs, for example. This is what he had to say there.
Payments by consumer continues to drive the U.S. economy. We've seen debit and credit card spending at about 6% year-over-year growth pace. A little slower, but still healthy. But remember, card spending represents less than a quarter of how consumers pay for things out of their accounts at Bank of America. Overall payments from our customers' accounts across all sources are up 9% year over year.
And as I mentioned, a different story when it comes to Goldman Sachs that gets most of its revenue from trading and investment banking, but at least Bank of America enjoying the gains this morning. Inez.
And we will be talking about Goldman in just a second. Thanks so much, Rochelle Akufo. Great breakdown. Buying the dip in banking, earnings for investment banks are continuing to roll out, reflecting a downturn in sentiment. But the gloom might present a good opportunity as long as investors watch the deposit bases and valuations of their potential investments. Here with more, Devin Ryan, Senior Research Analyst at JMP Securities, a Citizens company. Devin, I know you cover a Goldman. You have a 460 price target on Goldman. What were your major challenge or takeaways from today's results?
Hey, good morning. So it was a good quarter. I think the headline was a little bit noisy. It looked like at first blush they missed on revenues. In reality, there was just some noise related to selling some of their Marcus loans. So the revenue picture was actually a little bit better than we had modeled on the kind of the core revenue drivers like trading and investment banking. And then, there's also some expense noise. So there was about 80 cents of some one-time expense items. And so when you kind of normalize all that, the quarter itself was good. I think what's more important, and I think why the stock's starting to probably get a little bit of a bounce here is, coming off of the call, they talked about starting to see, some green shoots forming again in investment banking. They said their trading clients remain very engaged and very active. So that means that second quarter starting on a pretty good note for trading. And then they're actually starting to see some market share opportunities as a result of, all the banking stress. For example, Credit Suisse, in private banking, there's going to be some opportunities to potentially come out of that transaction for Goldman Sachs as well. And so, I think that's kind of the bigger takeaway here, that the go forward is arguably a little bit better than we thought heading into results. And so, I think the market's just trying to figure out with all the noise from the headline this morning.
Well, let's talk about some of those opportunities. Goldman CEO David Solomon talking about those high net wealth businesses, business clients, perhaps from taking that from UBS, Credit Suisse. So how significant is the market turmoil that happened for Goldman?
So just to take a step back, Goldman has navigated a lot of crises over its history. And through those crises, it takes market share, whether that's in trading or investment banking or now increasingly in asset and wealth management. And so, on the private banking side, it's probably not the primary driver, but it's all incremental. When you have firms consolidate, generally customers want to have more than one relationship. And so if they were working with both firms before and then those firms get together, then they're going to look for another counterparty as an addition. And so that's where Goldman can step in Europe in private banking, but also there will likely be some investment banking market share up for grabs and trading. And then just bigger picture, if we're going into an environment where the financial system is going to be maybe tighter with capital, Goldman is very well capitalized, and they're already starting to lean in terms of committing capital to clients. I think we're seeing that a little bit in some of their financing lines. We'll see that in trading most likely out of them in the next couple of quarters. And so those are a couple of the obvious opportunities, but they navigate these moments really well, and that's one of the reasons that we like them. You mentioned noise in the headlines, and this is with respect to Goldman as it's been pulling back from consumer lending, selling about $1 billion of its Marcus loans, as you had mentioned. So how significant is that? So it gets a lot of attention, but it's not that significant to results. We're talking about single digits of kind of contribution to revenues, and actually the business has been losing money. So when you exit that actually kind of helps from a profitability perspective, and it helps free up capital. And so it's been in some areas a little bit of a distraction relative to how much it's driving the business. They're going to stay in consumer. There's areas of consumer where it makes sense, and they spoke about those on the call, but kind of this broader consumer strategy, particularly in an environment where investors don't have a lot of appetite for companies to lose money. I do think it makes sense to kind of pare back some of that kind of grander vision. That's what they're going to do here, and I think it makes sense.
And it's in a partnership with Apple Card, with the Apple Card holders that we just heard about that announcement yesterday as well, about launching high-yield savings accounts for Apple. So do you think that that's an area of importance going forward?
Yeah, absolutely. I think it's more about, the partnership angle, right? So Goldman has partnerships with a lot of marquee brands, and I think the interesting question would be what else comes on the other side of that, and what else will they do with Apple? And I think they're going to continue to launch products, and that product in of itself, I think will be a good product. I'd argue that there's other products in the market where there's a yield that's competitive with that, and so I wouldn't expect there to be a huge flood of deposits into that platform. So in terms of the ability to move the needle, I think it's more of kind of a longer term play. But I think that Goldman is now taking the tact where if they can do it on their own profitably, they're going to do that. But if there's partners to work with where they can share some of the expense and also get access to customers in a new way, that can also make a lot of sense for them. And so they'll kind of take both routes. And Apple's a great partner to have, huge household brand with huge customer base.
Some of the commentary also heard on the call from David Solomon is basically that the worst of the crisis is over. Do you think that that's a case? I mean, is the banking crisis over?
So the data that we're tracking right now is positive. So in terms of what we're tracking out of the Fed with the HH data around deposits, just even in recent weeks, that has been stabilizing. And then getting to bank earnings here, you're seeing, I think, at least some stability in the stocks. Today is a little bit of a choppy day, but more broadly have been reacting favorably. Our view heading into earnings was that the large banks would likely do better than the smaller banks. So we still have ways to go here to get on the other side of all of bank earnings. But we have been seeing some more comforting data. And then just more broadly, the view kind of into the customer base, the consumer, while it may be slowing a bit, it's still hanging in there. And more broadly, that the companies are still seeing relatively healthy credit trends, across their franchises. I think that's a positive data point. So we do feel better today than we did 3 weeks ago.
Devin Ryan, Senior Research Analyst at JMP Securities, a Citizens company. Thanks so much for joining us. Coming up, China's consumer is back with a bang, but it's been a long road getting there. Will the spending boost translate to higher profits for corporate America? We discuss that next. Stay with us. Talk of recession abounds, but China is doing its part to help the global economy. GDP came in ahead of forecasts, expanding 4.5% last quarter on the year. JP Morgan and Citigroup both boosting growth estimates on the world's second biggest economy on the back of that print. The big story there is the consumer, and the push to get people to spend looks like it's finally paying off. Retail sales jumping 10.6% on an annual basis. That's the biggest monthly jump in almost 2 years. From the corporate perspective, Tiffany owner LVMH saw a spike in quarterly sales last week thanks to largely to the pickup in demand. And the rebound also catching the attention of luxury sector leaders like L'Oreal. It bought cosmetics brand Aesop this month. Hugo Boss was an early international luxury brand to enter the nation. It also refocusing on growth in China. So what does this mean for your investments? Luxury is notoriously seen as recession-proof. One way investors like to dip their toes in is through the consumer discretionary sector. And VettaFi points out that has had a fairly solid 2023 so far, despite the volatility in asset classes. You can see an uptick in the Invesco's S&P Consumer Discretionary ETF. On more of pure play basis, VettaFi cites flows in thematic ETFs like the Global X Millennial Consumer Index, or MILN for millennial. Meanwhile, the China Golden Dragon Index continues to balance the reopening narrative with geopolitical concerns. And China's luxury consumer may be seeing a comeback, but is the U.S. consumer also seeing buying increase in the luxury sector? Here with more is Yahoo Finance's Brooke DePalma. Brooke.
Well, good morning, Inez. The post-pandemic splurge and what we saw here in the U.S. as consumers look to spend post-pandemic seems to be dwindling down a bit. Based upon LVMH's latest quarterly results, we saw revenue growth there up just 8%. Now, that was far lower than what we saw in Japan, what we saw in Asia, as well as Europe. But LVMH said that while Asia is quote-unquote improving fast, they said that revenue growth here in the U.S. was good, but they did say softer. And as you could see there, 8%, the lowest revenue growth out of all its markets. And taking a step back and looking at overall retail, according to foot traffic analytics company Placer.ai, during the third week of March, overall retail foot traffic was down 7.1%. But during the first week of April, we did see a bit of an improvement there. Overall foot traffic down just 2.1%. But of course, we'll see in May, late April, when Target and Walmart and other consumer-facing companies report, if consumers are still making that switch over to food items, over discretionary spending. In March, we saw CPI, when it comes to groceries, down 0.2%. And so finally seeing a bit of relief in food, hoping that it then reflects in these companies' quarterly results.
And how is the consumer, speaking of food, how is the consumer in the dining space? Because so much attention is paid here in the U.S. to services and the dining sector and dining out. How are they faring that?
Yeah, well, it seems like inflation is finally hitting the consumer's ability to dine out. Based upon, once again, Placer.ai's foot traffic analytics, we saw overall foot traffic during the first week of March, the week of March 13th, we saw foot traffic down 4.4%. But yet, Americans are spending more when it comes to restaurants. In March versus March 2022, spending was up 13%, totaling $96.5 billion. Now, the reason behind that, the rate of inflation to dine out was up 0.6%. And so while Americans are dining out less, they're actually spending more. And so ultimately, when it comes to Americans' ability to dine out, it seems to be lessening a bit. But of course, this comes as that rate of inflation of food away from home is increasing. And maybe Americans are beginning to just cook more at home.
Yeah, and it's a trend that we see. They are spending more and getting less for that.
Right.
Thanks so much, Brooke DePalma. And coming up, the debate over how we measure economic output has been around for decades. So should we do away with GDP altogether or tweak the way we measure it? We speak with a leading voice on that narrative. Stay with us. President Biden signed an executive order today to improve access to child care and better work life for caregivers as he makes a push to filter more money into the caregiver economy. But our next guest says caregivers still remain invisible from economic statistics. Misty Hegenes, a University of Kansas Associate Professor of Public Affairs, joins us now. Misty, I know that you are working on an initiative that focuses on caregiving and household work that women do. Why is this an important issue which should be considered in official stats?
Yeah, so Inez, thank you so much for having me today. And I just want to start by saying that I'm very appreciative of the Alfred P. Sloan Foundation for their generous funding for this project, for the Care Board project. And I want to start by just saying that there's a lot of economic activity that happens within our economy that we're really not focused on reporting on and collecting statistics on. And what that means is that when we have epidemics like the pandemic, where a lot of folks are moving from outside formal labor market into their households, there's a lot of economic activity happening in households, and we're not really capturing any of it. And so we're not getting a full picture of our economy and how our economy is thriving and growing. One example is in 2020, if you look at GDP, if you include economic activity that happened within households, that basically was the equivalent of about a fourth of the total U.S. Official GDP. And so it's a big area of economic activity that we're really not focused on.
And when you say economic activity, what exactly do you mean? I mean, when we're talking about household work that women do, caregiving, there's a lot in there. So what are some examples of what economic activity is in the household?
Yeah, so I mean, if we want to unpack that, it includes things like caregiving of your children, making meals, washing clothes, cleaning. It includes yard work and things that we do around the home. All of these all of the activities that we do to kind of maintain ourselves as humans and help us thrive and live our best life happen within this sustaining care activity that's going on within the home.
And it's
economic activity. If we were to have somebody come in and clean our home, we would pay them for that, and it would be counted within economic statistics. And so there's really a challenge here in terms of why we count it when we have somebody come in and clean our home, and we don't count it when we clean our home ourselves.
And how do you quantify or measure this work?
Yeah, so this is one of the areas where it does and it can get very challenging. And so essentially what economists would do in that instance is we would look at the time spent in these particular economic activities, and we would look at the opportunity cost, or what's the value of that person's time if they were to be doing something else. And so if somebody is staying home and taking care of their children, if somebody steps back from the labor market when they have children and takes care of their children in the home, what is the value of their wage that they would have had they been in the labor market? And that's generally how we think about quantifying a lot of these activities.
It's so fascinating. So it's basically the work that one does at home for their household, their loved ones, their family members, but it's not necessarily, though, a work that if you bring in an outside nanny or if you bring in an outside cleaner, you're not necessarily counting that's not going into these stats.
Well, actually, if you are bringing somebody in from the outside and you're paying them, that's already counted within our kind of official statistics on the economy. And so the challenge here is then how do we add in the value of individuals who are engaging in a lot of these activities, but for non-pay because it's a part of their family structure. And one example where I think this is really important, and again, it refers back to the pandemic, is you had a lot of caregivers, particularly mothers, who got really burnt out. And it wasn't, part of it was because they kept their regular full-time or part-time jobs and were doing that out in the formal economy. But in addition, they had a lot of additional responsibilities within the home. Mothers got really burnt out, and we weren't able to really accurately tell the economic story of caregivers during the pandemic because we really lacked the infrastructure and data around those stories in order to really understand the experiences of caregivers.
And how will the data improve the wage gap?
Yeah, so, a big part of the wage gap today is not due to kind of overt sexism in the labor market and in the workforce, although that still does happen to some extent. But a big portion of the wage gap today is due to something that we call the motherhood penalty, which is really focused on this idea that once women start having children, they pull back from the labor market for a short period of time, and that really puts a very strong negative impact on their lifetime earnings potential and their earnings in that moment and forward. And so one area where we can try to understand better why the motherhood penalty still exists and continues to hinder women's ability to thrive economically is if we're better at capturing the alternative amount of economic activity they're doing when they're not in their jobs, which is raising the next generation of workers, contributing to human capital and social development of society, which is so critical for a strong and thriving economy, and also critical for economic growth. And if we can get better at capturing and acknowledging and compensating for this alternative types of economic activity that are so critical around care, we might be able to figure out ways to mitigate some of the gender paid wage gap.
A lot to look into. Thank you so much, University of Kansas Associate Professor Misty Hagenes. We appreciate it. Coming up, a key bellwether. Some would say it's the last big pharma group standing. Johnson & Johnson runs a gamut from biotech to consumer products, but not for much longer. We take a closer look next. Stay with us. Now it's time for Big Pharma to step to the plate. Some would say in that sector, Johnson & Johnson is the last of its kind, running the gamut from biopharma to consumer care. It reported a beat in its latest earnings, the first as it continues to work towards spinning off its consumer division. What does this mean for the rest of pharma? We have Yahoo Finance's Anjali Kamlani with more. Anjali.
That's right, Inez. As you note, Johnson & Johnson is still one of those big conglomerates with the consumer health business still in play, but it is working to spin that off right now into Kenvue. A couple of comments this morning from CFO Joe Wolk about that, and specifically about how the company is thinking about looking at it long term. The portfolio right now has about 30 products that are billion-dollar brands, and without the Kenvue products, it would reduce to only 26, and that's according to Woke at a recent conference. So you can see that it's not going to necessarily be too much of a hit as it moves forward. There was also commentary about the impact of inflation and whether or not they're seeing that impact as much, raising prices also in the consumer health business. Woke again saying that it hasn't had an impact on the volume. And in fact, the company has remained strong on that. So that outlook seems pretty good. Also, the impact from COVID has been something that they focused on, reducing the impact there and not expecting it to be much of a disruptor anymore as it was. Specifically on that medtech business, as you see on your screen, up this quarter. And that's something that has changed over the last couple of quarters. It has suffered, as we know, surgical procedures and the like, hospital procedures and the like have reduced because of COVID. There is seeing a rebound from that, including in Asia, which was, impacted earlier this year. So that's sort of the mixed bag picture, if you will, of what's going on right now. And specifically talking about the consumer health unit, you're right. The company is not the first to do this. And in fact, it's been increasingly a trend in the pharma industry, as you discuss, the diverging sort of needs of R&D in the pharma space and then in the consumer space. And we've seen that, as you can see on your screen, GSK spinning off into Haleon, Pfizer into Upjohn, and then Johnson & Johnson now working its way to Kenvue. And that's just some of the recent ones we've seen. We know IQVIA, an important pharma watchdog and a consumer report producer, really pointing to how this, talks about the divergent needs of the two segments of the company. And so likely to see that continue. We already know Sanofi may also be looking at that in some other parts of the world. So not too much of a different trend, but definitely something to be interesting looking forward, especially how that impacts R&D spend.
And Johnson & Johnson stock is down more than 2% after its results. Thanks so much, Anjali. And new year, new budget, new IRS. The government agency secured $80 billion in additional funding thanks to the Inflation Reduction Act in August to be implemented over a 10-year span. And already taxpayers are seeing a huge difference. The IRS hired 5,000 additional phone operators before this tax season, bringing down call wait times to 4 minutes. The agency is also answering 80 to 90% of all calls, compared with only 17% during the last fiscal year. The IRS is also looking to improve outdated technology, streamlining the filing process. The agency says the funds will also go towards boosting experienced staff as the IRS seeks to crack down on wealthy households and businesses that dodge taxes. The agency says they have no plans or no immediate plans to increase the audit rate for households below the $400,000 threshold, saying they have years of work ahead. And the IRS estimates they lose $496 billion each year in unpaid taxes. That tax gap driven in part by a lack of tax knowledge. A recent survey is shining a light on just how significant tax literacy is for small business owners and gig workers who face complicated hurdles when filing. Joining me now to discuss the importance of closing the knowledge gap is Caroline Bruckner, Managing Director at American University Kogod Tax Policy Center. Caroline, so there's $496 billion a year. What's behind that tax gap?
So our research suggests that it's more than just people willfully evading their taxes and is more consistent with people not understanding what to file when. A full 1/4 of our recipients, 76 or our respondents, 76% of which were college educated, all of which were small business owners or gig workers, didn't know what to file when. Almost 33% of our respondents didn't know what quarterly estimated payments are, and they didn't learn about it in college or high school. So we are starting to think that this is more of a tax education rather than an administration problem.
And also there's research that shows that 37% of small businesses and gig workers surveyed, they struggle with feelings of anxiety and confusion. So what needs to happen in order to make the process less anxiety ridden when filing taxes?
We need to be telling people what's owed when and when things are due. And we need to make it as obvious as possible. The IRS can't go at this alone. They're going to have to partner with other agencies and meet small business owners where they are. And one way they could do that is to partner with all of the various federal agencies that have small business financing programs and really work on education, curriculums, and outreach efforts through those existing networks. That's one way to really get attention to these issues.
And is this just for small businesses and gig economy workers? I mean, or is it just for regular individuals that have full-time jobs? I mean, how does it scale when it comes to the scope of those that are paying their taxes?
Well, so the biggest problem that we've identified is with people that are doing side hustles, and that is a growing number. Our recent private sector data shows that there are now 65 million people that are doing some kind of work on the side. And our tax system isn't set up to help those folks file their taxes on time and get the refunds that they're entitled to. And so we need to actually really target those folks, because most folks that get a W-2 and just have one full-time job, they can figure out what they're doing. There's withholding in place. Their employers work with them to make sure that they're paying their taxes on time. But it's the folks that are working in lots of different ways. And this is a movement that is growing exponentially and has continued to surge post-COVID.
And because of that change in the economy and gig workers increasingly in the economy, I mean, the changes in tax codes, is that contributing to sort of the confusion as well? Because should the IRS be putting forth more, hey, we've changed this, by the way, remember, we changed this. I mean, should there be more information coming out so that taxpayers really have it in their face that the tax code has changed for this year, for example?
Outreach is absolutely necessary, and the IRS needs to be partnering with different groups and agencies like SBA, who are targeting these groups of workers. But also, we should be updating our financial literacy courses across the board in high schools, community colleges, universities, to be including more information about this growing trend of work and how to meet your tax obligations, because these are how the next generation of workers are going to work. And our tax system is not set up to facilitate tax compliance with respect to these 60 million workers.
Yeah, it seems complicated. I have hired a tax accountant for that because I tried to do it myself, couldn't do it. So it's complicated. Thanks so much, Caroline Bruckner, Managing Director at American University's Kogod Tax Policy Center, for breaking that down for us. Coming up, the East-West divide. It's a tale of two housing markets in the U.S. These days, the West is slumping while the East Coast rockets. We look at what housing starts data tells us about the state of play. Next, stay with us. We're getting a glimpse at the state of the housing market this morning. U.S. housing starts declined in March as building permits plummeted. This data is closely watched by economists for a look at how the economy is faring as the Federal Reserve battles inflation and as mortgage rates skyrocket. For more on the state of housing, let's bring in Adam Beam. He's a founder and CEO of Beam, a fintech company for contractors that helps them get paid more seamlessly. Adam, so you're on the front line. You're seeing the payments that go to the contractors. What are your observations about the overall health of the construction industry right now?
Yeah, thank you, Inez, for having me. It's a really good question. And, we see that generally construction is a very diversified industry. And so residential contractors, if housing starts to decline, they switch to other types of products, major home renovations, additions. So, generally the best construction companies are not seeing a slowdown. If anything, they're having trouble getting access to the skilled labor that they need to continue building more housing.
And I'll get to that skilled labor in just a second, but are you seeing a sort of bifurcation when it comes to commercial? Because I know that you deal with both, with commercial and residential, when it comes to commercial construction versus residential construction.
Yeah, so I can't speak broadly of the market here, but what I do see is that we're seeing a shift from new construction of office buildings to interior renovations, tenant improvement, et cetera. So the same is true in commercial. It's highly, highly diversified.
Interesting. Are you seeing it because there's now talk about office buildings that are going to be turned, or the idea of turning them into residential? Have you been hearing from the industry players there about plans to turn some of these office buildings into apartments, let's say?
Yeah, you hear about it. It's happening in Texas. It's happening in other states with more relaxed permitting rules. But overall, it's a very difficult process. We don't have any contractors today who are doing that, but I'm certainly excited by that idea. And we need more housing. Connecting back to housing starts, inventory is at an all-time low. We need to be building more housing. When we zoom out, we see that we're in a housing crisis. And so despite the number of housing starts going down on a month-over-month basis, we still need to be building a lot more. And so Beam looks at the market in more of a 10-year view. And we know that we need to be building more housing.
And staying on that housing theme, do you see different areas of the country that are tighter than others areas of the country? I mean, because there are some states where you have more housing starts, and in other states, you've got the blue states where there's not as much. So what are you observing?
Yeah, it's a hyper local industry. And so the statistics we're seeing are really aggregated across the entire country. But if you look at a specific city, or if you look at a very specific even municipality, you're going to see a very different story. And so what we see, I'm here in San Francisco, we see a lot of development of ADUs, accessory dwelling units. We see a lot of major home renovations. We're not seeing as many housing starts. But if you go to the Midwest, you'll see a lot of new housing starts. And, it's just the nature of the industry is it's very, very localized.
And let's talk for a second about the labor market when it comes to construction, because during a slowdown, or when there's a slowdown, construction is really the sector where you see sort of the deterioration happening. But we're not necessarily seeing that in construction. So is there still a very tight labor market when it comes to the construction industry?
Completely. We are in a 600,000 skilled labor job shortage. So there's openings for 600,000 skilled laborers. And that is really the prevailing statistic in the industry. If housing starts to decline by a couple percent, that doesn't change the fact that we are missing skilled laborers. And so really what Beam's thinking about in the long term is how do we get construction businesses to be more efficient, to have access to more capital so that they can hire more workers, train more workers, and build up that skilled labor pool. That's going to drive construction prices down. That's going to make it easier to build more housing. That's going to get us out of this housing crisis that we're in.
And how has the recent banking crisis impacted, if at all, the construction industry? I mean, have you heard from construction players about lending standards, about concerns about lending standards?
You know, we don't work too much on the lending side of things, and so I don't have much to say there. But what I can say is that a lot of construction businesses and a lot of contractors do work with small regional banks. They saw, I think, most of what happened with Silicon Valley Bank as kind of a one-off. Folks that we work with were not particularly concerned. I think that mortgages overall are you know, we're seeing in the numbers that folks are still able to get them. The interest rates obviously are higher, and so it comes at a higher cost, but we're not seeing sort of broadly any major shifts there.
Yeah, definitely. There's still strong demand for housing, at least here on the East Coast. Thanks so much, Adam Eagle, Beam founder and CEO. And coming up, more chaos for travelers. The FAA briefly issues a nationwide ground stop for Southwest Airlines. It's since been lifted, but it isn't exactly confidence-inspiring. We'll get into that story next. As we wrap up the show, let's take a look at some trending tickers. Here are the biggest movers ahead of your lunch break. First up, shares in Southwest Airlines recovering some ground after slumping on an FAA nationwide ground stop. This has since been lifted. It had been issued on what it called equipment issues. The FAA says there is still a hold on flights into Dallas Love Field Airport. Data from FlightWare shows around 2,500 flights were delayed. That's around 30% of Southwest Southwest schedule. We're also keeping an eye out on the banks on a big earnings day. Shares of Bank of America and Goldman Sachs both lower in midday action. Bank of America's rise in profit was boosted largely by higher interest payments. The bank's net interest income jumping by 25%, matching reported performances seen at JP Morgan and Citi. A different story, though, at Goldman Sachs, the bank posting an 18% fall in profit. Goldman's revenue is heavily reliant on Wall Street activities, unlike its more diversified rivals who enjoyed boosted income from fixed income trading. Chairman and CEO David Solomon called the first quarter a real-life stress test, but did bring some optimism to the call, saying he believes the worst of the bank crisis is over. And let's do a final check of the markets. Right now, we are looking at all three major averages, which are lower. Healthcare, utilities, communication services are leading to the downside. That's it for me. I'm Ines Ferre. Thanks for watching.